The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hi, I'm Esther Gulius, the tax lady from EG Tax, and 3 or 4 times a year we do shows where we don't let you call in, and today's one of those days. We're doing our chewing up the email segments today. So again, if you want to be part of the show and you don't really want to call because you're too shy, this is a great way to have your questions answered by going to our website at egtax.com. Ask the tax lady, put your information in, and we will feature your question on one of our upcoming shows, and that's one of those today. So I got Tiffany Fabian here in studio with me. Hey, Tiff.
Hey there, Esther.
How are you?
Very good.
And Christopher Fabian.
Hello, Esther.
Hello, Norman.
Newman.
Newman. Anyway, so we're going to devote this show to answering your email questions. So what do we got? Something good to start off with?
Sure.
Do Connie, Christopher.
Connie.
Okay, I guess I'm doing Connie.
Okay.
My son has owed the IRS a lot of money since 2014, and due to illness, he hasn't been working and really can't pay anything. They keep calling here and threatening him, and he's getting depressed because there's no money to get. Those commercials on TV say they can help. Do you do it too?
Well, we do, but if I could chime in, there's also something called an uncollectible status. And so that means if you look at all of his expenses and all of his ability to pay those expenses, if the expenses yield greater than his ability, he could be in an uncollectible status. The IRS would run through those numbers. And after 10 years, if you're in an uncollectible status and you call every year and your income and the situation stays the same, the debt would be wiped out.
If you think about it, that's really, and I'm sure that there's a lot of people that are in that situation. Mm-hmm. So let me just chew it up a different way. If you are in this situation, he has no ability to pay. So you kind of have to get your gumption together, call the Internal Revenue Service, and you say, hi, this is Mom. My son is unable to do this. Maybe put him on the extension. He doesn't work. He's on Social Security disability, has no income. Then what they do is they stop the collection process. Mm-hmm. If you call every year subsequent from that point on for 10 years and he still remains in uncollectible status, what do they do with the tax liability?
Wiped out.
They forgive it.
Yep.
I don't think New York State does that.
Probably not.
I called.
Probably not. But we're talking about the federal.
Right.
So that would be the cheapest thing for you to do if he remains in an uncollectible. Now, here's the other thing you have to think about. Let's say that this is a short-term disability. He's unable to work, but you anticipate in a year or two he's going to get his job back. You might want to look at an offer and compromise, because as soon as he's able to work, all of that accumulated penalty and interest and the liability is still there.
Comes alive.
And so you might want to do an offer and compromise right now and see if you can't settle that debt so that when he is able to work, it's not going to be a gigantic burden. So those are the two things that I can think of.
Right. Well, a couple things. Tiff brought up New York State. I know it's 10 years after they issue a warrant, or the debt's gone if you can't pay. If at this point, maybe he just waits out if it is New York State on him, and that New York State debt, believe it or not, will just fall to the wayside. So that's I hate to say that is an option, but for some people that is an option.
Well, but I mean that kind of goes with the first thing
yep.
she had said. But
yep.
But the thing is, will New York State stop collection?
No.
Okay.
It will always. You just got to ignore the bills. Right. And the second thing is, I know Connie said they keep calling there. IRS doesn't call people.
Mm.
If you get phone calls.
No, actually, if you have they have debt collectors now.
Yeah, they go to your door.
Yeah, I mean,
I have
New York, the IRS once you have a bill, then they will call you. because they have a debt collector agency now.
Not very often, right?
Not very often.
Right.
I would be very careful if someone.
Well, especially some of those fake phone calls.
Exactly.
Where they said that you have to give us $5,000 this minute or we're going to come arrest you.
They've been calling you. You've gotten lots of correspondence. Right. Lots of correspondence beforehand.
Okay. What else we got?
I got Alex. It's so funny. I was just walking down my neighborhood and I saw this, people having this. What credit is a credit available for going solar? Is there really a good credit on both the federal and the state? I don't know if I should believe my sales guy.
What credit is there for going solar? Mm-hmm. Well, there is a big credit.
There is.
But here's the thing. When you listen to your sales guy, he doesn't know your tax situation. So he only knows that you get a 30% credit and a 20% credit, and he's touting all of these credits, and that's limited by your tax liability.
Well,
so
first is limited to what you actually pay.
Right.
It's not because
tax liability.
Well, no.
You pay the solar people.
What you pay the solar people.
Oh, that's what you mean.
Yeah,
okay.
Because they're going to come in and say, oh, it's $20,000, but after the NYSERDA rebate, it's only $12,000. Your credit isn't based on the 20. Your credit is based on the 12.
On the actual amount you paid for the installation of the panels. Mm-hmm. So how much is the credit, Chris?
30% to the federal, 25% to New York State.
Of
what's left. But you have to have the tax liability in order to take the credit. It does flow over year to year, but New York State, if you're a retiree from New York State, you don't pay taxes to New York State. So there goes the 25% credit. So you got to back that away from when you're looking to see, is it worth it to go solar?
Esther, when you had solar a long time ago, did they have that credit?
There was a different kind of credit.
Okay.
That was a million years ago. And actually, we had the solar installed. Oh, my God, this was really 30 years ago. We had the solar installed, and I don't think it ever turned on.
Oh,
and it cost me all this money, and the credit was caca, actually.
Oh.
So, anyway, that's different. That's a horse of different color.
I was curious about that.
So let's just say that, let's say you have a home of modest means. Let's say you have $80,000 in total income, right?
Okay.
And your itemized deductions are $15,000 because you're a recent homeowner. So, and you have a family of 5, 3 kids, mom and dad, right?
Okay.
So now we're going to take another
$20,250
off there. So your tax so you're going to be taxed on $45,000. All right. So, but all 3 kids are under the age of 15. So your tax liability is going to be around $6,000 minus 3. So now your actual liability is 3. And so let's say you have your $20,000 that you borrowed to put the solar panels on your house. So that's $6,000 credit that you'd get. But your liability is only 3. So all you can do is use the 3 to offset the tax liability you actually have, and then you carry forward the rest of the money to next year. So if you're thinking that you're going to get this big windfall this year, it may not
pay
happen.
for it, yep.
Yeah. And then speaking of that, I had a client this year who had a electric car, and he got he has quite a bit of liability, and he got a credit for the car. I know it's only applicable you have to, until it reaches so many cars sold of that brand and of that type, and so you have to be really judicious and not always listen to the salesperson.
Right. And so it's always best. So and just like Chris said, let's say that you're a recent retiree and you have very little New York State tax liability, if at all. Even though there's a 25% credit, it's not a refundable credit. It's only used to offset liability. If you have no liability, it's not going to help you. So it's very important you check. Okay?
Yes.
All right. Well, what we're going to do right now, we're going to take a short break, and we'll be back with you with, no, not your question, with your emails on the other side. Hi, I'm Esther Gullius, the tax lady from EG Tax. Thanks for listening to Ask the Tax Question. Ask the Tax Question. Ask the Tax Lady. This Saturday, we are not taking live phone-ins. We're chewing up your emails. Next Saturday, we'll be back with live phone calls. So, and again, if you want to be part of our show through the email portion, go to our website at egtax.com, ask the tax lady, enter your tax question, and we'll be very happy to answer your question immediately and use it possibly on another show. Okay?
Okay, I got Joy. She says, Esther, I am a hairstylist and my employer makes me pay taxes on like I'm self-employed. But I don't think I'm self-employed. And I've talked to her about this, but nothing happens. What should I do? This happens quite often.
Well, in order to be just because you're the person that you're working for says you're self-employed doesn't mean anything unless especially if you are what's considered a common law employee, which means that they tell you when to come, they tell you when to go, they tell you what we're paying you.
They bring in the clients.
Right.
They give you the
They're paying
equipment.
for the supplies. They're the ones paying the rent. It's their equipment. All that kind of is so, and you're not allowed to substitute. Like, let's say you're a hairstylist, but you say to your daughter on Monday, gee, I can't go in and take work today. Can you come in my place? If you can't substitute the person doing the work, means that you're probably a common law employee, which means that you can actually call New York State Department of Labor and turn in that person, and New York State would start an investigation, I'm assuming, and then would determine whether or not you are an employee or not, and could force the employer to pay for your FICA, your workers' comp, your unemployment, and penalize them.
Yeah, well, this is such a growing topic. I know a few years ago they actually came up with, what's the form number, Chris?
8919.
That's what I was going to say, 8919. And you can do this on the tax return. So you can put on the 8919 after we go through the test and you deem that you are indeed an employee, not self-employed, and half of the FICA and Medicare will go to the employer and you'll have to pay the other half. And so that's a form that's really there for your toolbox.
Have to do the SS8 as well, which will start the investigation.
Right.
Yeah.
Now, isn't that pretty much nobody lets the employer know
Who it is.
Right.
Correct.
So you'd have pretty much
Anonymity.
right, anonymity. As to, of course, if you're the only employee, then that's kind of a problem. but obviously, employers would like to not have to pay all the taxes and would like to not do the workers' comp and all that kind of stuff. But it is the law, and you should, if you're an employee in New York State, you're entitled to have your workers' comp, your unemployment, and receive minimum wage. Those are things in the law, so you want to make sure that you follow up with the state of New York, and they'll be on your side.
Not to mention, if that employee got hurt and you don't have workman's comp, and then the poop hits the fan, and then you have to have all those back years, and then you're in a litigatable situation.
Right. And they can shut down the employer too.
Right.
Okay, what else we got?
Dave writes in, I heard that I'm going to get an extra $2,500 in my refund next year because my daughter is starting college. This sounds too good to be true.
Well, it may be too good to be true because it all depends on how much of the tuition and books is actually going to be the child's responsibility or your responsibility. If she's on a full scholarship and all you're paying for is the books, then the credit's going to be limited to the books and supplies that you actually have to pay or borrow. But if, in fact, you do pay or borrow the tuition for your child's education, then there is a credit which is partially refundable called the American Opportunity Tax Credit. You guys want to explain how it works?
Yeah, the first $1,500 is served as a non-refundable credit, which goes to eat up your tax liability, and the next $1,000 is potentially a refundable credit, which means even if you don't have liability, that's still something you have money in your hand. So really good. But something I wanted to say, if we live in New York State and they're going to have potentially free education, and so that would remove this credit from Dave if his child was getting the education paid for.
He would lose the New York State credit if
right.
And again, it all depends. New York State is only paying for the non. In other words, if you have TAP and Pell,
Right.
that has to be taken into consideration. Then they pay the rest of the first 4 years if you're taking so many credits, and the parent's income is under $100,000 based on 2014. What are those
2015
forms?
tax
Is
FAFSA.
it 15?
It's 15.
15?
The
Oh, it's
FAFSA.
15? 15 FAFSA, yeah. So if they made over 100,000, and the kid is still going to have education that they have to pay for, then they'd still qualify for the American Opportunity Tax Credit.
Right.
I mean, and again, any other if their books are not covered, I don't think that's under the state of New York, and maybe some of their fees.
What were you going to say?
I was going to say there's just so many little
Nuances.
Innuendos.
Yeah, that come in, sit down, let's talk to see what's actually happening, because it's not automatic 2,500. That you got to go through the hoops and do the limbo a couple times.
And on the state of New York, there's also a refundable credit.
And then I
for
can't
the first 4 years
tell
of
you,
higher education.
I'm thinking about a mom who she's in a divorce situation and she pays for her daughter's college, but the father gets to claim the year, taught her on off years, so she doesn't get to claim the college, and she just about cries at my desk the years that she doesn't get to claim. So the college credit follows the child.
Right.
And speaking of child, don't let your college student claim themselves.
Unless they're making like $20,000,
Right.
I mean, they're or you have no liability. I mean, if you have no liability, let's say the kid is making more than you, then that would be a situation. But in most cases, the kid is living in your home. Even though the student loans are in the child's name, you can still claim the child and the education credit. Right?
Mm-hmm.
Okay.
Mm-hmm. And don't forget the New York State education credit as well. I got Sam. He says, EG tax, I want to retire, but I'm not sure if I can afford it. I'm 61. I work a part-time job making $18,000 a year. I only have a small 401k of $35,000 and another pension from my company I work for 10 years, which will pay about another $500 per month. My Social Security is projected to be $1,350 per month, but I was told to wait until the age of 70 to collect the maximum. In the meantime, all I have to live on is a small pension, my 401k. What are your thoughts?
Well, I think that he should
61.
get his Social Security, number one.
Yeah, if you go to our website, Chris and Tim have helped to put in a nice little chart. You plug in the figures, it tells you how many years
There's
it
a lot
would
of figures here. Is his
take it away.
wages $18,000?
His part-time wage is $18,000.
All right. So by next year, when he's if he waits till 62, he can still work. He can work less, or the $18,000 he's right at the top. I would suggest that he collect his Social Security, right? Mm-hmm. So now he's got a Social Security plus his wages, and he wouldn't have to necessarily touch his 401k plan.
That's right. That's right.
And I would save that 401k plan for as long as he possibly can before he touches it, because again, like we talked about before on many of our shows, if you take a look at the Social Security that he's giving up like $16,000 a year in Social Security. Over that 8-year period, he's giving up $108,000 in Social Security, and the increase, it's true, he's going to have a 32% increase over what he would have had, but that 32%, I'm doing my ciphering, is $4,000. So that $4,000, it's like 15 years before he breaks even. So that means at 85 and a half, he'd be ahead if he waits till 70. In the meantime, between 62 and 70, I don't know if he's going to be passing a 10 cup on the corner,
right.
But to me, take your Social Security now, enjoy it while you can, because you're young,
And
Burr?
correct me if I'm wrong, but he gets $35,000 a year. So it sounds like he has a pension, which is a dying animal and all.
No, his pension, he said, was only $500.
401k is only
He only has
I
$35,000 in it, so he
Okay.
wants to keep that as long as
Yep,
he can. And if
absolutely.
he's working, now that he's getting the Social Security, if he's working, he might be able to put some money into an IRA too. Build up that
and,
IRA.
I'm going to throw a monkey wrench into this whole thing.
You
because
always
that's
do.
what I do. Is what's he going to do for health insurance?
That's true,
I mean, he's too young for Medicare,
right?
so he's for 4
Sounds
years.
like the essential plan.
Maybe.
But he's
Maybe.
so old. I don't,
But
older,
I mean, that's a
don't know.
major. He may not be. I hate to say it. May not be able to retire because of the health insurance.
Right.
And so
Or
we don't know.
or
Or if-
gamble for 5 years and not have health insurance, and hopefully he stays in good health.
Right.
Because health insurance could cost him.
But yeah, and then what if you have? I guess we don't have the penalty anymore if you don't have health
Well,
insurance.
we don't know that yet.
No, we really don't know. Everything's kind of up in the air, right?
Yes, yes.
Well, okay. So I'm Esther Golias, the tax lady from EG Tax 80. No, we don't want you to call this week. Next week, call us. We're doing emails. We're going to take a short break for the news. We'll see you on the other side. Hey, I'm Esther Golias, the tax lady. Thanks for joining us on Ask the Tax Lady. I have Tiffany Fabian and Christopher Fabian here with me in studio, and we're doing emails today. So don't call in. Next week, give us a call with your questions. But again, if you want to be part of our show with the emails, write us. Go to egtax.com, go ask the tax lady, write your email questions in, and I will answer them right away. But we also may use them on a later show. Okay, what do we got?
I've got this long little saga here.
Saga.
EG Tax. I am having financial problems, and I'm really ashamed to talk to anyone. On the outside, my lifestyle is very upscale, but in truth, I owe a lot of credit card bills. My salary's good. I make over $100,000 a year. I'm single. I have a really responsible position. What's getting me pushed is that my fiance has no idea about my debt, and she'd be very upset if she knew. I own a house, but my house payment is $2,500 a month. My car payment is $350. It's a lease, and my credit card debt is over $40,000. So those payments are killing me. The payments are around $2,200 a month. So with everything, I pay over $5,000 a month, and that's before my utilities and cell phone. My 401k at work is worth around $150. So do you think it's time I withdraw from this? Well, I wonder how old he is.
I don't know. It's interesting because for him to have $150,000 in his 401k, one would assume that he's a little older,
Right.
But, well,
Wow.
first thing you got to say is I think that marriage is built on trust.
Right.
And I think that you should enlist the aid of your fiance
Right.
in tackling this problem, number one. Because if you do take the money out of your 401k plan to pay your credit card debt, that's money that you won't have later in life. And even New York State protects your ability to not take the money out of your pension plan in a bankruptcy because getting older is a reality and you're going to need the money later. So I guess what I would say is I would sit down and do a budget. Number one. Number two, look at all the assets that I could get rid of to pay down the liability. Now, I don't know what the equity in your home is, but if you do have equity in your home, and Buffalo has a really strong real estate market right now, you might have somebody come over and take a look at your equity in your home, and you might have enough equity to do a home equity loan, which would be at a very low percentage, which would be tax deductible. You would pay off your credit card debt, have a cutting up the credit card party in the kitchen one day, and that would be a way to get rid of the debt without taking $40,000 out of your pension. If you take $40,000 out of your pension, assuming that you're under the age of 59 and a half, it sounds like, then your tax liability is going to be at least $10,000 with a $4,000 penalty, so that's $14,000, plus with New York State, another 3, so you're looking at $17,000 in taxes you're going to pay if you take it out of your 401k. The money's gone, $17,000 in taxes. So now you're going to have to take out more like $57,000 in order to cover your liability. So
I know one of the things that we do at EG Tax is we do budgets. And first, you have to have one of those come to Jesus reality moments, and you got to see where your money's going. And then you listen to other people and who are financial people, and they always say, tackle your debt if you can't do it this way. We're paying down the smallest credit card, maybe with the highest interest first, and so you eliminate one, and then you take that payment and you apply it to the next and the next. But you really have to be disciplined, and you have to be like a laser, and you have to be focused, and you really have to tackle this.
But here's if the equity's there, I would look at that.
And I think above all, a foundation has to be built on truth. And I like where you started, and you said he had to tell his fiancée.
What do you think, Chris?
Oh, right. If the equity's there.
All right. If the equity is not there,
maybe go to his parents and ask for a loan.
Yeah. Well, for me, you have to say to yourself, why am I paying $2,500 a month to live in this house? Maybe I should downsize. Maybe my fiance and I should get a less expensive house. But all of that comes with telling the truth. Maybe the lease vehicle that you're paying, you should sell the lease vehicle. You should trade in that lease vehicle and get a good used car. It's interesting. I was working with a couple of clients not long ago, and they both were driving Lincolns, and they were paying about $600 a month for the payments. And I said, why don't you just go trade in those vehicles and get 2 good used vehicles? So they did. They got $12,500 cars. And one was like 1 year old and the other one was like a year and a half old. Right. So their payments went from $6,000 down to $250. I mean, from $600 to $250. So that's $350 that you could put on your credit cards. So I mean, it's all of those kind of real those lifestyle decisions that can eliminate a lot of the things that you're stuck with. So either you increase your income, decrease your debt, look at the equity in your house. The last thing I would do is taking money out of the 401k.
Right. Maybe when you're going to be honest with your fiance, maybe your fiance will be honest with you too, and maybe she'll say, oh, well, you know what? I'm $30,000 in debt too. So, you know what? Maybe you get married, and if the income's not there, there's no equity. You file a bankruptcy, which is an option. A lot of people don't like filing it, but start off fresh.
Fresh start. And that's the part I was going to go into next. Bankruptcy is bankruptcy protection. And I have to tell you, if you're young and getting started and the world is your oyster and you thought all the oysters and pearls got to be yours and you made some bad decisions, a bankruptcy is something to look at, because quite frankly, if you're that pushed on your credit card debt, probably your credit score is not so hot in the first place. The other thing you might want to do is look at the repayment debt, do the bankruptcy with the repayment option to get rid of a lot of your debt that way. And that's another option, which I thought was great that you brought up.
I was listening to Paul Caputo, who does our offers and compromises at the office, and he was sitting there talking to a young lady, and it sort of parlays with this. And he said, if you're paying the IRS in New York State and you're making the payments and you look at your statements and the principal is never going down, you're never touching that principal, you just feel like you're in this rat race and there's no way out. And the truth is a bankruptcy. So if this person just keeps paying the minimum, and it's the principal's not going anywhere, we don't live in a debtor's society. Bankruptcy is an option.
Yep, that's right. And we have several bankruptcy attorneys that we work with, and I will tell you, it is not the stigma that you think that it is. Many of my clients that have had to do it, and it's a have to do it, right? Have said the year after they did the bankruptcy, I'm so glad I did. First of all, nobody's going to give me credit for like 2 or 3 more years, which is great. I'm learning how to live on cash.
Right.
and it's a lesson well learned.
I know our daughter wants to be a bankruptcy attorney, so she says this month, and so that it's a really good it's a really good tool that you have. at
Okay,
your
what else
disposal.
we got?
Susan writes in, my husband just started a lawn cutting business. He bought about $7,000 worth of new equipment. He told me, don't worry, we'll get it all back when we do our taxes. Is he right?
No. No, he's not right. I mean, again, everything goes back to, and like we said time and time again, whatever your tax bracket is, whenever you have a deduction, you multiply the deduction by the tax bracket. That's what you really save. If you and your husband are in the 10% tax bracket, the $7,000 will save you $700. And that's it. So you go,
that's-
liar, liar, pants on fire.
That's if they have the income to offset,
That's
to
true.
take the full expense
That's
of the
exactly true.
$7,000.
That's exactly
where they
right.
may have to depreciate that over
For
5
years.
years.
Right.
So yeah, come in, sit down,
Right.
and we'll talk, and we'll see the best strategy going
Right.
forward.
But don't be mad at him. He probably, I mean, so many people think that, that you get to write it off. You do get to write it off, but again, like Chris says, if the income's there. But again, it's multiplied by your tax bracket. So,
And like you said before, or maybe you didn't say it before. Usually, while you're
That I should have
building,
said it before.
you're building your business, the IRS will anticipate or allow you to anticipate a loss for the first few years because you're building your business, and so this is something natural. But
$7,000 in write-offs is not going to get them back $7,000.
No. But
And
like
that's
you
what's
said,
so
don't be
sad.
mad at them.
When I'm doing a tax return and I start off and people are saying, "Oh, we're so excited because John bought $7,000 worth of equipment for the business, and boy, we're going to get this big refund." I say to them right off the bat, maybe when we put everything together, the result would be a good result, but the $7,000 is not going to, unless it's a $7,000 credit. That's different.
Yeah.
A credit and a deduction are two different things. A credit is actually dollars saved. A deduction is a deduction multiplied by your tax bracket. So get credits, not deductions, if you possibly can. Mm-hmm. Right?
Yep.
What might be a business credit that?
Worth $7,000.
No, I mean.
Oh, well, how about if you have payroll and you're in an empowerment zone,
Right.
you have somebody who lives in Buffalo and works in Buffalo, then you get a credit.
You get a 20% credit
credit.
of the wages that you paid.
Yep.
So that's real dollars.
So
right?
say you pay them $10,000, 20% credit is $2,000 in your pocket, but a $2,000 deduction at 10% is only a $200.
Right,
So-
and so if you paid them $11,000, and it was in an empowerment zone, they would get a $2,000 credit from the empowerment zone and a deduction for the $9,000 in wages times their tax bracket. So that would save them a lot of money. Okay, what we're going to do right now is we're going to take a short break for the news, and we're going to join you on the other side on Ask the Tax Lady. Remember, if you want to be part of our email program, go to egtax.com, Ask the Tax Lady, and you can ask a tax question, and we'll make sure we get you on a future date. But this week, no phone calls. We'll be back on the other side. Thanks. Hey, everybody. This is Esther Gillies, the tax lady from EG Tax. That wasn't a news break. That was our commercial break. All right. So let's finish up with our emails. Next week, we'll be back with regular phone-ins, but this week we're doing our email show. So what do we got?
I have Nick from Warsaw. EG Tax. My brother is unfortunately a drug addict and spends most nights when he finally gets in on my couch in the basement. He has no income. He's 27. He's been living with me on and off for more for the past 4 years. Is there anything I can do as related to taxes to claim him? He sleeps here, eats here. I buy him food and clothes. Warsaw.
Well, okay. So obviously, if this guy's got no other source of income and he's not doing stealing on the side, so which is illegal income, and he's not selling drugs, making money, if he really has no income, then there's 5 dependency support tests. Obviously, he lives with you. He's a relative. He doesn't have gross income over the personal exemption. He is a citizen of the United States, and he's a resident here, so he would be your dependent.
Yeah.
What I would suggest you do is take him to your doctor and see if you can't get him Social Security Disability, SSD, because first of all, maybe Medicaid would kick in, maybe he'd be able to get into a rehab program. So it isn't just about the taxes, it's about his overall welfare. And I would also amend, if he's been there for several years, I'd amend those years' returns and claim him as a dependent. Yes, sir.
Here comes that monkey wrench.
Yes.
Does he have health insurance? Because the money you would save for claiming him, depending on your income, remember in 2016's tax return, it was 2.5%, or what was it? Why can't I think of the dollar amount? $8.95 a person. If you're only saving $600 a year by claiming your brother,
Right.
and it's costing you $900 in a tax
that's
penalty,
true.
it's not worth it to claim your brother. I hate to say that.
That is true. That is true. That does throw a monkey wrench in it. Well,
But then
nothing else.
What if we don't have the penalty in 2017?
Right. That's
But
true.
going forward,
but going back.
Yep.
Right.
Yep.
But if he doesn't have health insurance, like you said, take him down to Social Security
Well, I
or
think he should-
income.
no
maybe
matter what.
go to Social Security, get him signed up for Medicaid.
Yep.
So get him going in a positive direction.
Yeah.
maybe.
No matter what, he should try to get him SSD. SSI, not SSD. SSI.
Yep.
Social Security based upon income. And it is true. The health insurance portion. Because everybody that's a dependent has to have health insurance.
Yep.
Unless there's some miraculous thing that this kid had Medicaid, I can't believe it. But
Yeah.
So yeah. But give us a call. We'll be very happy to help you. Yes.
Okay. Brett writes in, Esther, I guess you can say I was lucky. I won a new car on a game show. But then when I got home, I realized I had to pay the sales tax, about $3,500. And now I was told I have to pay income tax too. I don't have any more savings to pay for taxes. Anything I can write off or any other ideas? Now I don't feel so lucky.
Well, I mean, you have to look at what's the value of the car. So if the car is worth
$3,500 in sales tax, you're probably looking about $40,000.
all right, so it's a $40,000 vehicle. So he could sell it.
Could sell it.
Right,
Yep.
because you got to pay the taxes on it. So if the taxes were $4,000 plus the sales tax, you said it's $3,500, right?
Yep.
So the sales taxes are deductible anyway. So you got $7,500. So he could take it in, and even if the dealer gives him $35,000 on trade, he's still way ahead of the game, and it's not going to be taxable because he's already paid taxes on it.
And then if he's an itemizer and he has gambling losses, he can write off his losses.
No,
It's not gambling.
He didn't. He just was on a game show.
It was a game show.
Yeah.
Different than being at a lawn fair
Right.
where
Yeah.
you buy a
So-
raffle ticket.
So I guess I would look at it
Yeah.
as it's cost me $7,500 to get a $40,000 car. You could always do a car loan for $7,500 on the car at 2% interest and to pay off those taxes that way. But it seems to me
How about
a
if
cheap
he's-
price to pay
How
for a
about
$40,000
If he's an
car.
itemizer, he could write off the sales
sales tax.
tax
The
on the
sales tax, right.
Schedule A. I mean,
there's just some things that
but I think Esther said it.
the bottom line is you got
Right.
so for $7,500 you got $40,000. Give me the car, I'll pay the $7,500 and that because it's true. Some people will say to me, I'm not working overtime because I got to pay it all to the IRS. You never pay it all to the IRS.
Right,
Never.
never.
The maximum you're going to pay is 35 with state of New York, like 41%. So the 59% still belongs to you. That would be if you're a gazillionaire, right?
Yep.
So it's not the case. So if you want to call me on Monday, give me the car. I'll pay the taxes.
That's what I thought you were.
It's pretty funny. I love watching game shows. I think most people do. But I think I'm one of the only ones who sit there and people go, oh, I'm going to do all this with my money. I go, but you're not going to have all that money. By the time you pay the taxes and you do this and you're down to here. Or when they do just win a car, they don't think then where this guy would pay $40,000 plus at 15.6 plus he's paying about $15,000 in taxes for $40,000. Yeah, sell it to make it. But people don't realize I want a car. I'm going to.
Right.
So,
but the thing is, it's still a wonderful thing.
Yep.
It's just not as wonderful as they make it sound.
Right.
Okay, what else we got?
I have Chris. It says, EG Tax, my husband and I are very involved in our kids' lives. My husband coaches my son's hockey team, and I coach my daughter's soccer team. Between the both of us, we drive about 10,000 miles and spend around $3,000 in supplies and travel, not to mention the 1,000 hours spent doing this. Is there any deduction for this?
Well, I mean, if they are placed in the position by a qualified not-for-profit
And not getting paid.
all right, and the travel is ordinary and necessary, and they're not staying at the deluxe Hilton in the embassy suite portion,
The penthouse.
right. So if they're just modestly incurring as little expenses as possible, then it's a charitable deduction.
That's right.
But you got to make sure you save all your receipts. You got to make sure that you're not just the parent of the coach. I mean, like your coach is the best friend, and so you're coming because you just really are a wonderful parent. You actually have to be in the position of authority for that league.
That's right. Yeah, I do a lot of people's tax returns, and they volunteer at church. And so, like Esther said, they were appointed by a bona fide non-for-profit agency, and you get 14 cents a mile, and you want to keep receipts, and you want to keep accurate records of this work that you're doing.
Right.
Right. And for volunteering, unfortunately, the hours don't count.
That's
You
exactly
can't
right.
put a value on your hours. So
Correct.
but that's a good thing you guys are doing. So keep your records.
Right.
Yeah.
But if say they do get paid $1,000, depending how they get paid, is it a 1099 or is it a W-2? Because
Well,
then,
or maybe it's just a reimbursement of expenses. If it's a reimbursement of expenses, then you would reduce your expenses by the reimbursement.
I just thought about this. You were going to volunteer at Kingdom Bound like you do every year, and the hotel that we had to pay for
It's going to be deductible.
is going to be deductible. Yeah. I mean, we've never gotten a hotel before, so.
Right.
But that's a ding.
That's
light
right.
bulb.
Well, when you work until 2:00 in the morning.
Yeah, no. But my
Okay.
hours don't count.
Nope.
my daughters do for high school for volunteering. But
Yeah,
that's a different
yeah,
Doesn't
story.
count financially.
I know financially it doesn't
All right.
count.
What else we got?
Stu writes in. Stu. I think it's Stu Boyer, but I don't think it's him. But you never know. Before my father passed away, he titled his 1968 Corvette over to me. I would love to keep it, but times are tough and I need money. What happens if I sell it?
Well, this sounds like this is a collectible. And so a collectible is something that you will have to pay tax on
25%.
At 25% on the gain. And so
But did he get before he passed?
Before he passed.
All right, so it goes back to Dad's original basis, right? So if Dad paid $10,000 for the Corvette and it's worth $50,000 now, there's a $40,000 gain. It's going to cost him $10,000 in taxes plus New York State,
Yep.
right?
oh, wow,
So
wow.
there's a lot of different things in there. So
Now here's something. You can put a loan on the car. Borrowed money's tax free.
That's
You
right.
can borrow the money at 2.99%. So if he were to take that $40,000 Corvette and let's say he needs $10,000, he would only pay $300 a year in interest on that,
Right.
rather than paying $10,000 in taxes. So he could keep it for 4 years. The loan would be paid off, and he's only paying like $900 versus $10,000 in taxes, and he still have the car.
That's exactly
that
right.
could be what almost Brett could do too. Going back to the oldie who won a car,
There you go. Borrow the money.
he could get a loan.
Right.
And the interest rates on car loans, like at Penn Fed, are
Are
so
2.99%. For those of you who have never been familiar with the Pentagon Federal Credit Union, they have great savings rates, great CD rates. Let's say you have a 5% car loan right now. You can do a refi on your car loan. I believe it's 2.49% if it's a 48-month loan. 36-month loan, and 2.99 if it's a 48-month loan. So think about that
But
too.
wouldn't it almost be a personal loan and using the car though as collateral? Because you're not purchasing the car, so can you still get the low interest rate on a personal loan?
They'll let you refi.
Refi on a no loaner.
Yeah.
I got Steve from West Seneca. I know we're running out of time. Tax lady, I received a letter from the IRS. You call it a love letter. and it reports that I owe $9,750. I know in 2015 I'd sold some stock in order to buy my wife out of the marital home after the divorce. Could this be why they're sending me the letter? My lawyer told me that wouldn't be taxable.
Okay. If it was a quadro where they transferred money from a pension to a pension out of the court-ordered divorce situation, that would be tax deductible. But because he sold stock, it's going to be potentially taxable. So the difference between what he paid for it and what he sold it for is going to be taxable. He's got to put it on a Schedule D, and we're running out of time. Until next week, I'm Esther Gulius, the Tax Lady, with Christopher Fabian, Tiffany Fabian. Have a great week. If you need us, go to egtax.com. We'll see you next week with your phone calls. Bye-bye.